When the provider belongs outside Singapore, it can provide services to a person who is also outside Singapore. Then of course there's nothing to do with Singapore GST. Or the recipient happens to be in Singapore. Now in this late, you've got to be very careful because we are now at the time of recording 2024, where we have already got reverse charge, and then we have got digital service, remote service. And then for the goods, for supply of goods, we also have something called LVG. Okay, low value goods in other words. So if the provider belongs outside Singapore, is there no GST implication for Singapore purposes? The answer, it depends. It depends on what? It depends on whether the recipient of the service based in Singapore is GST registered or not. If it's GST registered, then I need to ask myself whether the recipient is subject to an RC or reverse charge. If it is subject to reverse charge, then it is required to charge itself the GST on importation of services. If the recipient is not GST registered, then of course the Singapore GST requirement would be based on whether the provider is required to register for GST under something called overseas vendor registration regime. So if it is required to register based on the OVR, let me just move a bit here so that you can see the OVR. If the provider is required to register for Singapore GST under the OVR, overseas vendor registration regime, then the GST will be charged by the provider to the recipient in Singapore, and this is when the GST implication will happen. So you may think it's out of scope supply for a provider outside Singapore. If it's purely if it's purely like the provider and the recipient are overseas, not belonging in Singapore, then I agree it is a very straightforward out of scope supply. However, what they mean by not out of scope supply is that when our RC reverse charge applies, when overseas vendor registration regime applies, it is only out of scope when there's no RC in issue, or under the OVR's regime, the provider is not required to register for GST. Now, if you meet either of this scenario, technically speaking, it is still out of scope supply at the time of doing this recording. Okay, so just a bit of the interesting point to know. All right, so accounting consideration is that you've got to know what is out of scope supply so that you know whether you need to put a particular amount in your GST return. Okay, that is something you need to bear in mind. I think it's very straightforward. Okay, so let's look at this case. Tax Advisors Consultancy is an IT consulting company provide consulting services exclusively to people outside Singapore. So this is a case where tax advisor is based in Singapore, provide services to client outside Singapore. Okay, so define out of scope supply in the context of tax advisor. In the first place, is it the right question to ask? You might say, hey, out of scope lah, because there's no GST wa. Well, the answer to this question is, let's go back to the basic principle. It's supply of service. If it's a supply of service, then I need to ask what is the place of supply. The place of supply is actually in Singapore because tax advisor is a business, is a person belongs in Singapore. In order for it to be zero rated, remember it's not out of scope supply. This is a classic case of potentially zero rated supply, because if zero rated supply doesn't apply, it is actually a standard rated supply. So it is a supply made to an overseas person. So then in this case, I will look at, because it's consultancy services, I will look at whether 213J or 213K would apply. Now, if you go through the criteria for 213J, because it's IT consulting services, chances are it will be satisfied unless there's somebody who is directly benefiting or who is a direct beneficiary of this consulting service, who is based in Singapore. We call it a DB, direct beneficiary in Singapore from this service. And the complication is that because we are under the new OVR and reverse charge, the exception to the exception is that, well, if we really identify a direct beneficiary in Singapore, 21(3)(j will still be applied if the DB is GST registered. I mean, this whole complexity of the rules, but just that in a nutshell, it is a standardized supply to start with, because TA belongs in Singapore. I may be looking at 21(3)(j to see whether I can zero rate the supply, provided that all the conditions are satisfied. So if I cannot find any direct beneficiary in Singapore at all, then chances are it can be zero rated. But there's no scope for me to even think of the supply as an out of scope supply. So just because I'm rendering a service to someone overseas, remember, it's not out of scope. Remember, our template is number one, is there a supply? And then number two, is there supply of goods or supply of services? And once we know the characterization, we apply the place of supply rules for goods and place of supply rules for services. It's that straightforward, in my opinion. Okay, so implications on the business operation. What's the financial impact? Well, the financial impact is pretty interesting. So number one, you've got to know the different types of supplies so that you know how to account for each of them properly in the GST return. And should you mix up or put the amount in the wrong category, that would become what we call an error in GST filing. And then that results in penalty. How about operational operational changes and compliance? Well, it is important for you to maintain all the record, because there's a record keeping requirement for GST, same as income tax. I say that this is at least 5 years. Okay, you need to maintain the record for that. And then the other thing is that you might already be GST registered, but somehow due to the changes of the business, your taxable supply, the value of taxable supplies drops below 1 million. And then you might be tempted to ask, do I want to go for deregistration? And then the question is that if you are not making a supply of more than $1 million a year, then the question is that the question of whether you want to deregister makes sense. And then if you identify the need to deregister, then you would then need to know the procedures to do so with IRAS. But the key thing is not about registration or deregistration. The key thing is about the word compliance. And what's compliance about is once you have the proper records and proper filing of the return, then the chances of being audited or being queried by IRAS will be quite minimal. You want to have more good sleep at night, isn't it? So therefore, it helps if you actually do something called compliance check. So in Singapore, compliance check. Now in income tax, I don't know whether you heard of this phrase called diagnostic review. It's like you suspect that you are not feeling well and you go to a doctor and ask for diagnosis. So in GST, do we have something similar? The answer is yes, we have. So the Singapore GST framework, we have got Assisted Self-Help Kit, ASK. We got ACAP, which is for bigger companies. And under the current framework, we got a Tax Governance Framework, TGF. Okay, so you may decide to come under any of this framework to ensure that the GST returns you have filed are correct, so that you have even more good night's sleep. Again, if you are not sure, refer to your materials or IRA's website, and you will find a lot of discussion about the differences amongst these three frameworks. Okay, and then we'll conclude with the last thing, the strategic business decision. What is strategic business decision in this context? Well, the context is very simple. just take note all products and services you supply would have GST implications one way or the other. And therefore, it is important for you to know how to ensure you have a proper charge or accounting of the output tax, how you can properly claim back the input tax when you are charged, okay, by another supplier. Take note of the law. I mean, the law right now is pretty straightforward, if I have to say that. We are now at the time of recording, we are now 9%. I personally do not foresee, this is just a personal opinion. Please do not take it as the gospel truth of what will happen in Singapore. I don't foresee any changes of the GST rate for a good 5-6 years, okay, at the time of recording. But let's suppose we are now in a situation where there is a talk where the GST rate is going to be increased again. Then you've got to ask yourself, what if the GST rate is now increased from 9% to maybe 12%? How would you ensure that you will still be able to charge GST properly? How are you ensured that there's no cash flow problem? How do you ensure that your clients have no complaints, no disputes about you charging GST at 12%? I mean, just for discussion. So all this becomes part and parcel of your strategic business decision-making process. Okay, so let's look at this case called Brew Cafe Private Limited. So Brew Cafe operates several cafes throughout Singapore, serving local and imported coffee and tea. They recently expanded their operations so as to include selling packaged coffee and tea online, which they also export to various countries. So a local business, Brew Cafe, now also serve online, okay, selling packaged coffee and tea online and export it to various countries. So the customers are either in Singapore or overseas customers. So again, you can see that here, because it is serving to local customers, so there could be standard rate supply. If it's serving overseas customer, there's a zero rate supply issue. It is based in Singapore, unlikely we have any out of scope supply unless the coffees are already packed overseas and the customer buy the coffee overseas. Okay. You may ask, would the GST implications change because I'm running online business? So if you study the materials, you realize that the mode of doing business has nothing to do with, I mean, there's no, your GST, this way, your GST implication will not change just because you are changing your mode of business operations from offline to online. Okay, we still go back to the principle, especially in this case, we talk about supply of coffee and tea. Okay, so whether you do it online or not, okay, it is the same rule applies in my opinion. Okay, so then the next question is that, okay, what will be the financial impact? What is the operational changes for compliance and strategic business decisions? You can imagine it's very important for brew cafes to understand and be able to account for the GST properly. Okay, based on the proper classification of the GST, I mean of the different supplies of different supplies for GST purposes. Since it is selling coffee and tea online to overseas customers, it means that there will be additional obligations when it comes to the export documentation requirement, which previously, based on the previous model, because it's only serving local customers, there's no need to worry so much about the export documentation requirement. Okay, and the other thing that might be mindful that Brew Cafe has to be mindful is that we earlier on talked about OVR for Singapore GST purposes. Just highlight that in this part of the world, OVR is not unique to Singapore. OVR may happen, no, actually has happened in other places. coffee overseas. Okay, you may ask, would the GST implications change because I'm running online business? So if you study the materials, you realize that the mode of doing business has nothing to do with, I mean, there's no, your GST, put it this way, your GST implication will not change just because you are changing your mode of business operations from offline to online. Okay, we still go back to the principle, especially in this case, we talk about supply of coffee and tea. Okay, so whether you do it online or not, okay, it is the same rule applies in my opinion. Okay, so then the next question is that, okay, what will be the financial impact? What is the operational changes for compliance and strategic business decisions? You can imagine it's very important for brew cafes to understand and be able to account for the GST properly. Okay, based on the proper classification of the GST, I mean of the different supplies of different supplies for GST purposes. Since it is selling coffee and tea online to overseas customers, it means that there will be additional obligations when it comes to the export documentation requirement, which previously, based on the previous model, because it's only serving local customers, there's no need to worry so much about the export documentation requirement. Okay, and the other thing that might be mindful, that Brew Cafe has to be mindful, is that we earlier on talked about OVR for Singapore GST purposes. Just highlight that in this part of the world, OVR is not unique to Singapore. OVR may happen, no, actually has happened in other places. Japan, Korea, Australia, China, Indonesia, Thailand. So it's not just about knowing the Singapore GST rules. To a certain extent, it might have GST or VAT implications in other countries based on this model that they decide to carry on. So the strategic business decision, as far as I'm concerned, is that I need to know where these customers are, so that I need to go and study the GST and VAT rules or check with the local tax advisors to ensure that I do not breach any GST or VAT rule in the particular country where the customers is located. Unfortunately, GST, VAT issues are getting more and more complex. And then the analysis is not just about Singapore. Again, I come from practical experience perspective. If you are just doing Singapore GST, it's not it's not so complex. Okay, so let's review some of this case study to wrap up, and then you can see, hey, the application of the different types of supplies. So Brightmart is a popular electronic retail store in downtown Singapore. It sells various consumer electronics. All items sold are subject to GST rate, standard GST rate. Its concern is it needs to manage GST on sales effectively, including accurate charging, collection, remittance of GST to IRAS, alongside with claiming the input tax credits on the purchases. So how would you ensure they have an efficient management of GST obligation? Well, they know the standard rate of supply, they are concerned how to manage it, right? So one thing you may want to take note of is to implement an integrated system, whether it's a country where the customers is located. Unfortunately, GST, VAT issues are getting more and more complex. And then the analysis is not just about Singapore. Again, I come from practical experience perspective. If you are just doing Singapore GST, it's not it's not so complex. Okay, so let's review some of this case study to wrap up, and then you can see, hey, the application of the different types of supplies. So Brightmart is a popular electronic retail store in downtown Singapore. It sells various consumer electronics. All items sold are subject to GST rate, standard GST rate. Its concern is it needs to manage GST on sales effectively, including accurate charging, collection, remittance of GST to IRAS, alongside with claiming the input tax credits on the purchases. So how would you ensure they have an efficient management of GST obligation? Well, they know the standard rate of supply, they are concerned how to manage it, right? So one thing you may want to take note of is to implement an integrated system, whether it's a POS, point of sales, or accounting system, that will automatically apply the GST rate to all sales and purchases. I mean, automation is actually preferable, because when you involve human beings, the chances of human errors would affect your GST compliance. So I think the easiest way to say is to automate the process and to ensure that minimal human errors, and ensure that GST is properly accounted for. So the outcome of that is efficient management of GST system, or GST obligations rather. You improve the cash flow, partly because you don't employ human beings, so to speak. And then you can fast track the claiming of input tax, because you can minimize the, you can actually make your system more efficient, and you might be able to accelerate the claiming of input tax faster and reduce the admin cost of doing so. Okay, so this is one thing to consider. Okay, so let's look at a zero-rated supply situation. So this case is about Global Exports, a company in Singapore, specializes in exporting locally manufactured goods or furniture to overseas, and they are zero-rated for GST purposes. The company's concern is it must ensure all export conditions are met to qualify for zero rating, including proper documentation and with time limit. So what can global exporters do to ensure efficient management of its GST obligations? So we have talked about this many times. It's about ensure you have export documentation requirements satisfied. Right? This is really the most important thing for export of goods. Okay, where possible, you think about it, you know that export documentation requirement is from IRA's website, from the export guide. Like I said in earlier discussion, in the presentation, earlier part of the presentation, I said that you are the finance professionals. Did you let other colleagues of your company, especially those responsible for delivering the goods for export purposes, do you actually teach them or educate them the export documentation requirement? And even though you decide not to educate them, you have to actually give them proper training, ask them to fill up a checklist. The checklist basically is a copy and paste from the export guide, and let them know every time when goods are removed out of the warehouses, the checklist must be completed, and all the documents that are spelled out in the checklist have to be obtained within certain timeline. So in that case, at least there's some rapport built between you as a finance professional and the one who is managing the operation of the warehouse, so that this will minimize all the hiccups of not keeping all the required documents, leading to eventually IRAS asking you to account for the GST at standard rate. That is what I tell my client to do. Okay? So residential property developer, we talked about this already. So this case is Investwell is a private residential property developer making exempt supply for GST purposes. And obviously it cannot claim input tax. Okay, if it's concerned as a result, it will impact operating costs. So what can Investwell do to ensure efficient management of its business operating cost? Well, I will say this, I mean, this may be just a representation from the client. So I will actually deep dive the company's business to see whether it's really just a residential property developer. Sometimes the client will tell you the principal activity. Jolly well, you know, there could be some other incidental or secondary activities, but the client didn't mention to you. So, and this will change the GST implication somehow. Okay, it is therefore important. And if the company cannot claim back input tax, then it's just tough luck, because this is what the rule says. I mean, there's nothing I can do if it only makes exempt supply. True? You may say, but then can I register? No, if you are just making tax exempt supply, if you are just making exempt supply, you cannot register. And this becomes part and parcel of the operating costs. I mean, to me, there's nothing you can do. It is what it is. Okay? Digital service firm, case study number 4. This is Code Innovate. It is a software development company, provides custom software solution to clients overseas. It's thought that this was an out-of-scope supply for Singapore GST purposes. Is that true, everybody? The answer is no. Code Innovate is a service provider belonging in Singapore. So it is thought that it's out of scope, but in actual fact, it's not. It's actually a standard rated supply unless it falls within Section 21(3), which might potentially be IS, International Services, and then it can be zero rated. I mean, this is always the framework. Just remember, just because you're providing something to as a service to overseas customer, is that out of scope? Unfortunately, the rule in Singapore is pretty firm. Service provider belong in Singapore would mean that the supply of service is a standard rated supplies. If it can qualify as an international service, then yes, you can zero rate the supply. If not, there's a GST charge of 9%. Straightforward, and yet still a lot of people are not aware what to do. Okay, the last one, the case study number 5 is Mixed Supply Cafe. So it is a local cafe that sells dine-in meals, which is subject to GST at standard rate, and packaged of coffee beans for export, which is zero rated, again provided that the export documentation requirement is satisfied. The challenge is to manage the GST implications of the mixed supplies, including accurate tax invoicing and filing. What can they do? So you notice that it's very similar to the first case study. How do I do it? It's number 1, automate the whole process. Okay, automate the whole process. Let the automation help you streamline and minimize human errors. But here, number 2, because that is an export of the packaged coffee, obviously the automation won't be so helpful. So this is the case where whoever is managing GST has to do what we talk about in case study 2, because you know there's an EDR requirement. Again, is to make sure that the export documentation requirement is satisfied. How do we satisfy this? It depends on who is the one managing the export of the coffee beans in the company, and then educate them or give them a checklist. Every time, checklist. Very, very tiring when we talk about checklists. Again, it is what it is. We can't avoid it. Remember, missing a piece of document can mean you may think it's zero rated supply. Actually, it ends up as a standard rated supply. Whose fault? Everyone's fault in this process. Okay, so that's the reason why you need to know and educate your colleagues in a company so that they can help you ensure the GST compliance process maybe they can help you to comply with the GST obligations. Okay, so let's summarize the key lessons in this particular presentation. So we have talked about supply. We have talked about different types of supply. In these case studies, we have also mentioned some strategies, approaches for effective GST management. and that serves critical considerations for business operations. Again, you have heard automation 2 times. You have heard the checklist a few times for export of goods. Okay, this is something you need to know. Okay, so any further resources and support, number 1, your materials will cover quite a lot of these, so I'm not asking you to ignore them. But other places to go for is IRA's website, because IRA's website, they have something called the export guide, the EG, export guide. I mean, you may want to download this and take a look of the detailedness of the export documents they expect, which is quite very interesting. Okay, the other thing, the resources, again, it depends on who you are. If you are the student, or if you are just a student, then you may not need so much about this. Yet, if you are a practitioner, if you are a finance professional working or in charge of GST operations in your company, then I always said, well, have a good relations build with your GST advisor. Okay, GST advisor, because your GST advisor can give you quite fast answer to your GST question. Number 3, remember CPD. So once you become a chartered accountant, ISCA itself gives you quite a lot of CPD opportunity, all the CPE courses on GST, and you can continue update yourself with the changes to the GST laws and regulations. And then obviously, last but not least, in IRA's website, they also get an update of what we call the GST topics. They may sometimes love to issue documents or write up, not just the e-tax guide, they started doing something called tax guides a tax write-up for different industries or different sectors. So you may, if you belong to a particular sector, who knows that there's a GST write-up for your sector, and it is pretty interesting to read. When I say interesting, it means it is useful to read. Okay, so I hope you enjoyed this presentation. I know it's a bit long. I hope you find some good insights and my sharing of the practical experiences on GST. So thank you for watching the presentation. All good wishes. I hope to see you again.